Okay, thank you so much, everyone, for being part of this. My name is Samuel Ibanda, and I'm here to take you through management decision and control, which is our second topic of this paper. Now, some of you must have been part of the introduction, and also in one of the first sessions where I went through some of these topics in detail. In case you missed this, you can always refer back from some of the recordings that we have. So basically, what does CVP mean? What does cost volume profit analysis mean? Now, the terms cost volume profit are really very common to you. Of course, cost, we're just trying to look at what does the business incur to ensure that it's actually doing the production for its goods. And then volume is to do with quantity. How much is the company producing, or how much, yes, in terms of production. But it could also, if it's not a manufacturing company, it could be looking at maybe how many customers the company is serving. Maybe it's a service company. So we need to look at different aspects and see how we can relate cost to volume. And then, of course, profit. When somebody speaks profit is like what remains when you get your revenue and remove your cost. Some other people may call it maybe expenses, but when you regard something as expenses, you have left out very, very important information, because as part of cost are also raw materials that may not follow under your expenses, but rather your cost of sales. So it's good for us to basically understand. So why would we study the cost volume profit analysis? It's good for us to understand that as businesses do the day-to-day business, you get to realize that over time, we want to understand, if at all we increase our volume, what is its impact on our cost? If at all maybe we increase our volume, what is its impact on the profits, or what's the impact on the revenue as well? Now, all businesses exist to make money at the end of the day, to make profits. So this model helps us evaluate what is the relationship that is between the cost, volume, as well as revenue and profit. So we're able to understand how the two interplay, how the three interplay. When one increases, how does it affect the other? You get it. So in here, of course, our main varying factor is the volume that keeps on changing. And volume keeps on changing in terms of, let's say, the customers that you're serving, or demand, whatsoever. So it's very important for us to understand. So, and that is why we are saying that volume CVP analysis goes ahead to look at the change in activity and the change in sales revenue, costs, and net profit. Now, the reason why revenue does not come so much into this picture, it's already embedded within the profit, because profit is revenue minus cost. Total, if it's total profit, it's of course total revenue minus total cost. You understand? Now, the CVP is allowing us, of course, to predict what will happen, because yours is, for example, you could have a certain level of volume that you're producing. Maybe you're producing 10 bags of sugar today as a company. So we are saying that this model helps you to tell how much of revenue will come in case I increase maybe my production maybe to 20 bags. How much profit will I get in case maybe I increase my production maybe to 40 bags? You get it. So it is one of those key reasons why companies adopt this model. Of course, one of the other things that we shall also try to understand, that the CVP model also helps us to know when we shall break even. Now, when somebody speaks of the CVP analysis, you always relate this to the break-even analysis as well, because the break-even analysis works very well with the CVP. The two are very related to each other. Though with break-even, we are just trying to look at what is that level that the company is either making profits or losses. Okay, like what's that point in time where the company is neither making profits or losses? That is the break-even point for a company. So we shall try to understand how break-even comes in as we proceed with our study today. So what we are saying is that, of course, as we proceed, we will be able to understand how the relationship of volume, sales, revenue, costs interplay. One of the things that we also have to put in mind that the CVP model has several assumptions that we shall be looking at. But one of the assumptions for us to take note, especially at this time, is the fact that CVP model best works for short run. Best works for short run periods. Now, you might have understood, maybe in your economics class, the aspect of short run and long run. Now, by short run, we're trying to look at a time where conditions are a bit not changing. For example, if it's a period like 1 year, that period is short term in a way that maybe the market prices will remain constant. Maybe the volume would also, of course, volume can easily vary with with maybe cost and revenue effectively, because one of the things that we really think that in the long run, because of different factors of the economy and so on, we have different things that really change along. What was a product that was on the market, like maybe a desktop computer, is now being replaced by maybe an iPad or a laptop or a phone. You get it. But also, we also want to understand that if it's a long run period, certain factors of production change. And this could be maybe, could be labor, could be maybe the raw materials and so on. So there are several things that happen when we are looking at things in the long run. So for us to have the CVP model best work for us, we look at it from the perspective of a short run period, normally a period of, let's say, 1 year. So, and that's why we are saying that if you're doing short run, then the profitability will directly be in dependent to the sales revenue. You know, for example, if it's in long run, you find that a company's profitability is not even dependent on, let's say, sales revenue, but maybe it's dependent on, it could be dependent on price. Maybe the volume has remained the same, but the company has actually gone ahead to increase its price. You get it. And some of these things could come because of the dynamics. For example, like we're in COVID right now, I want to tell you that the dynamics are totally different from when we're in the normal way of doing things. So it's important for us to have that in mind, even as we continue to dig deep into this topic of CVP analysis. Yeah. So one of the other things that also need for us to understand is that CVP analysis makes use of what we call the contribution concept. Now, if the word contribution is coming, is new to you, I know from the English word, I think you've heard about contribution, people saying contribute towards something. But when it is business, we are basically saying that contribution is looking at your sales and your sales revenue, and then your variable costs. Your sales revenue and variable costs. If it's a single unit product and we are looking at contribution, we'd look at the price and look at the variable cost. You get it. So it's one of the things that we shall interact with even as we proceed. I usually want to demonstrate this in a much better for you to understand even better. So let me do something here. So I want to give you an insight onto the CVP model and some of the things that you need to have in mind. Now, we are saying that CVP model is looking at cost, and it's also looking at revenue, It's looking at revenue. Just try to increase the size of this. So it's looking at revenue and it's looking at profit. Now, when somebody says cost and it's for business, they are looking at two things. They are looking at fixed costs. They are looking at fixed costs, and then they are looking at variable costs, because total cost is the summation of fixed plus variable cost. Now, we shall try to understand more of how to calculate each of these as we proceed. When somebody speaks of revenue, of course, revenue itself is a factor of price, and quantity is a factor of price and quantity. And that is why people say that revenue, if it's a total revenue is equal to price times quantity. Price times quantity. So that is what happens with revenue. We are going to learn more. So when somebody speaks of profit, I say that profit is looking at two things. It's looking at what is your total revenue. What is your total revenue? Subtracted, what is your total costs? What is your total costs? Like that. So as we have said, that cost is basically a summation of, if it's total cost is equal to total variable cost. The word why we use the word total is because continuously you have maybe a single product, you can also have two products and so on. So we have total variable cost plus our total fixed costs. Our total fixed costs. Now, what happens for us also to understand as we go ahead, of course, this can also be loss. We are not saying that this is only working where a company is making profits. That can also be loss at the end of the day. So we have some key formulas. We translate this in terms of formulas. So you get to see sometimes when they are bringing in things like total revenue is equal to price, which is denoted by P, then times 2. Or sometimes it can just be P2. You get it, huh? And here, this is something that you should find easy, because total revenue is like how much has the company made, how much has come in, and that's why they are looking at how much have we sold in terms of quantity. If we've sold, let's say 20 bags, then how much revenue, how much have we sold that? For example, if I've sold, let's say 20 bags, and I've sold each bag at let's say 10,000, maybe it's a passion fruits or whatever it is. So if I multiply 10,000 times 20, I now come to 200,000. So that is my revenue. That is what has come through. So that is why revenue is a factor of price and quantity. The higher, of course, the higher the quantity, the higher the revenue. And the same thing with price. The higher the price, if quantity is remaining the same, then we have higher revenue. You get it? So it's very critical for us to have that in mind. And then when it comes to costs, the total cost, when it comes to total cost can be denoted, okay, sometimes they can denote it as TC. TC is equal to C I usually want to, okay, let me call it C for now. C, then 2. Now, this C is basically is the variable cost per unit. I think I can use V. Yes. Or VC. In case I was writing, I would write V, then write just a C down. So what I'm saying here is if this is V2, where V is the variable cost per unit, plus my fixed costs, which somebody can call FC. You get it? Huh? So that should be something that should come out very easily. And we are saying that if this is our profit or loss, whatever it is, and we are saying that our profit, which can be noted by P, let me just write this so that you don't confuse it with price, is the same thing as your total revenue, which is P2 minus. Now I'll put a bracket because total cost itself, I'm basically going to subtract total cost, which is V2 plus FC, like that. So that is in simple, I could even put it here. What I'm trying to mean, or what I'm trying to demonstrate, is the fact that profit itself is total revenue. Okay, I've already indicated it. I can just say in short, total revenue minus total cost, like that. So that is what we basically have. Now, there is what we call contribution that we just looked at before we could get here. Now, contribution, as profit is looking at the total revenue and removing variable cost plus fixed cost. Contribution itself, its concentration is only onto the sales less the variable cost. Less the variable cost. It means that for this, we are excluding the fixed costs. You get it? So what will happen right here is you can also, I said, you can look at total contribution. You can look at total contribution, but also you can look at the contribution per unit. You can look at contribution, but then you can also look at contribution per unit. So this is our, if this is our total contribution, it will be total sales less our total variable costs. So total sales less our total variable cost. If we are looking at contribution per unit, then what will happen, I'll just note here contribution. Will equal to the unit price less the variable cost per unit. Variable cost per unit. So that is what we will basically have. You get it? Huh? So it's good for you to understand this even as we proceed as well. So we are going to see how using CVP, we can basically see how all these relate with each other. You get it? Huh? Yeah, so it's important for us to first understand each of these. Now, as we are looking at CVP, one of the things that I've brought up here is the aspect of break-even point. Is the aspect of break-even point. And it's good for you to understand that at break-even, which I would say BV, total sales, the total sales revenue or total revenue, just to be consistent, will always equal to the total revenue will always equal to the total costs, will always equal to the total costs. And this what it means is basically the company is neither making a profit or not making a loss. You get it? Now, from the way companies run is today you start a company. Now, it is presumed that you don't start selling from the first day. But as you don't start selling from the first day, you actually incur costs from day one. And of course, the costs that you're going to incur are costs that have set up this company. Maybe those could be URSP costs. Those could be maybe research and development costs. Even before you do any sale, you have some costs that you have incurred. Now, after you've set up your company, after you've done your research and development, and now you have a product, now you go into the market. Now, at the start, definitely you continue to make a loss because when you compare your revenues at the start compared to the cost that you're putting in most cases, they're usually high. So because they are high, it means that you're making a loss when your costs are high to compare to revenue. So you continue to make a loss. But as the business grows, at somewhere, somehow, you actually get to a point where your total costs are matching your total revenue. And that is what we are basically trying to mean here. So at that point in time, when your total costs are meeting your total revenue, that is a point that we are calling a break even. Like it's a breakthrough. I think you've heard the word breakthrough when people say that was my breakthrough. So also for businesses, this is like it's breakthrough because beyond the break-even point, this business now starts making a profit. You get it? So at this point in time, since our total revenue is equal to total costs, it means that even our profit will be zero because remember, we've said that profit is total revenue minus total costs. So it means that at this point in time, your profit will actually be zero because you're not making, when you subtract your total costs from total revenue, there's nothing that remains because your total revenue is equal to your total costs. So it's important for us to have that in mind. So just to recap something, on contribution. Somebody says recap on contribution. Now, contribution, I said, contribution is looking at total sales and total variable costs. Contribution is like profit, but now, profit goes ahead to also look at the fixed costs. But for contribution is only looking at the variable costs. For example, if it's let's say, a bottle of water. If we are looking at the contribution from that bottle of water, definitely we shall look at the selling price of how much we've sold this bottle of water. Then we shall look at the costs, the variable cost on that bottle of water. Now, what is a variable cost? A variable cost are those costs that change with a change in output. So for a unit product, for example, for water, the variable cost could be maybe the cost of the bottle itself is a variable cost because it's directly, you can directly trace it to the product. You get it? So the cost of the bottle, it could be maybe, let's say, the cost of the water itself. You know, when you're looking at variable, actually, when somebody's looking at variable costs, some of the things that they are looking at somebody can also call these direct costs. So if you're looking at maybe direct materials, like the materials that are directly used in production of that product, you're also looking at things like direct labor. You could also look at the other direct expenses, maybe packaging, where you're charged by each packaging, by each bottle as well, and so on. So when we are looking at when we are looking at contribution, we are saying, with us not looking at let's say how much fixed cost, because when you speak of fixed costs, these are costs that will not change even with a change in output. These are costs that will always remain constant. Of course, like I said, for CVP, this is like a short-term. These are short-term assumptions. As you proceed to study, you get to realize that even the fixed costs change because of maybe the long run they change. But for matters of this discussion, the fixed costs will remain constant. You get it. And some of the fixed costs could, let's say, for example, maybe the salary of the CEO. This could be maybe the rent of the warehouse. These are costs that cannot be attributable to a single product. You cannot say that maybe this product, we spend, maybe this bottle, we spend maybe 2 shillings on storing it in the warehouse. So when we are doing, of course, allocation of fixed costs, we shall get to realize that we use different methods of allocating. By allocating, I mean, how does each of the product get a portion of some of these fixed costs? You get it. So it's very important for us. So contribution is only looking at total sales revenue less your total variable costs. And that is if you are looking at total contribution. If you are getting down onto contribution per unit, for it, we look at the unit price less the contribution, less the variable cost per unit. And I've indicated what variable costs mean. You get it. The direct material, the direct labor, and then the direct costs, other direct costs that you might have there. Yeah. So it's very important. So we are saying that at break even, our profit is 0 because definitely our total revenue is equal to our total costs. You get it. So what that means, that even with this formula, where there is profit, for example, I'm just trying to substitute where there is profit. We are saying that 0 will equal to the difference between the revenue less V2 plus FC in bracket. The reason why I put them in bracket is because of this positive and negative. I don't want us to mix the two. So if we are saying that at break even, our total revenue is equal to the total cost. So what does that mean? You get it. So, and we are going ahead to say that that would mean that our profit will be 0. Now, if we want to now get our break-even quantity, there's what you call break-even quantity. Now, break-even quantity. Break-even quantity. Now, your question should be, what is break-even quantity? When somebody says the word break-even quantity, because we've understood the break-even point, that it is at that level where the company is, the company's total sales revenue is equal to the total costs. And that is a point in time where the company is not making a profit or not making a loss. It's basically there. The profit is 0. You get it. The profit is 0. Now, I indicated also earlier on that the reason why that happens is because the company grows from just starting with the costs, then starts earning a revenue. Then at a point in time there, the revenue now matches the costs. So at that point in time, that is where we have our break-even point. Now, break-even quantity, here we're trying to say that what is that quantity? What is that volume of at that time when this company is actually break-evening? So what is that quantity that will make this company to break even? And why this is very important is because the organization has to plan. Yes, we are a new organization and we are producing goods, but we are still making a loss. But ours is to determine what will make us go forward. What quantity of production do we need to get us forward? You get it? So at break even, we said our profit is equal to 0. So For us to get the break-even quantity, we shall get here and say at break-even, total revenue is equal to total costs. But total revenue is equal to P times Q, is equal to P2. I say that this is price times quantity. And then, total costs will equal to variable cost per unit times the quantity, just to find the total variable cost, plus the fixed costs. You get it? So if we are saying that at break even, our total revenue is equal to total cost, then this must be true. Then this is true, that it will be P2, price times quantity, is actually equal to VC plus FC. I'm basically trying to replace what I have in here, because we're saying at break even, total revenue is equal to total cost. So I'm trying to get the formulas for each of these and trying to replace them. So it means that my price times quantity is equal to the variable cost per unit. The variable cost per unit, let me just try to change this. This is V2. The variable cost per unit times quantity plus the fixed cost, which I'm representing by FC. Now, okay, you can go ahead to say where. Now, if that is the case, that our price times quantity is equal to actually V2 plus our fixed cost, it would mean that we can actually create Q as the subject in this question. Those that studied mathematics, you must be remembering how we used to make a given letter a subject in an equation. By saying that we are making Q the subject, is we want to only have Q on a given side. We only have to have Q on a given side because we want to get what? Our break-even quantity. So it would mean that since I have P2 here and have V2 here plus FC, I see Q appearing here. I also see Q appearing where there is P. So what I'm going to basically do is I'm going to move V2 to this side and only remain with FC here. The reason why I'm moving this V2 this side is because they all have Q. So I want to make Q the subject in them. So what will happen? I'll have my P2 minus V2 equaling FC. Now you know that when you move something from here to the other side, it becomes a negative. That is why it is like that. You get it. So if that is what I have, now, once I have this, I can put Q out of the subject. Q out of the bracket, and then I'll have P, which is my price, minus V, which V I'm calling my variable cost per unit. And I'm saying that this will definitely always equal to my fixed cost. You get it? So if I want to get Q only, what I'll do is I'll divide by P minus VC on each of the sides. So I'll divide, I'll go ahead to divide P minus V on this side and also this side. So that will give me, that will only give me Q equaling to the fixed cost, Q equaling the fixed cost divided by, I'll use that, P minus V. P minus V. You get it? So that is how my formula would be like. Just for you to get it much better, I could use this and say that my break-even quantity, my break-even quantity will equal to, now up I'll have my fixed cost. I'll have my fixed cost, and we are saying it is divided by price minus variable cost per unit. You can see it is fixed cost divided by price minus variable cost per unit. I'm just transferring what I really have here to write here. You get it? Huh? So it's pretty important for us to understand that. So that's what I have. Now, I just did something here where I say that contribution is the same as total sales. I can change this total revenue just not to confuse some. So this total revenue minus total variable cost, that is the total contribution. If you are looking at contribution per unit, we say that contribution per unit is equal to the unit price. You can also call it unit selling price, whatever it is, minus variable cost per unit. You get it? So as we have this as our break-even formula, which is saying that break-even is equal to fixed cost divided by price minus variable cost per unit, we are saying that this can change to this. So your break-even quantity can also be, instead of having price minus variable cost per unit, this can also be fixed cost divided by contribution per unit. Because we've already agreed that contribution per unit is actually price minus variable cost. You get it from what we've just looked at up here. So this formula can also be break-even quantity is equal to fixed cost divided by contribution per unit. You get it? So it's very important for you to understand this. Now, there are cases or times when they'll ask you for break-even sales revenue, where they'll ask you for break-even sales revenue. Now, we have said earlier on that sales revenue or total sales or total revenue is price times what? Times quantity. Is price times quantity. So if we have the quantity, if this is our break-even quantity, then we only need to multiply it by what? By our selling price. And we shall have what? We shall have what we call the break-even sales revenue. So if this is what we have as our quantity, we are now going to multiply it. This multiplied by, I'll use that star, or you can use your X. This multiplied by the selling price. By the selling price. You get it, all times P. You get it, huh? So I hope we are following. So we are saying that our break-even sales revenue is equal to fixed cost divided by the contribution per unit times the selling price, times the selling price. You get it? Now, for us to take a pause here, as we proceed, we are going to understand these things as we go ahead. What we are saying here is, if this is what we have, if this is our break-even revenue equaling to fixed cost divided by contribution per unit. Now, I know some of you must have understood or come across what we call reciprocals. And the way reciprocals work is that any number, if it is A is the same as any number, A is the same as use this. A is the same as 1. Just going to use something here for you to understand. A is the same as 1 divided by 1 divided by A. Do we agree to that? I'm just trying to use my computer here to indicate how reciprocals work. That for you, if you have, if you divide 1 by 1 over something, it is actually that something. You get it? We can try something with 2. The reason why I'm demonstrating this is I want to bring something that you'd want to pick up. So we are saying that 2 is the same thing as, let me just try to copy this. 2 is the same thing as 1 divided by a half. When you divide 1 by a half, you actually come to 2. You get it? Because like if you have like maybe bread and you divide it into 2, that is like a half. Then you actually get 2. You get it? I'll try to use another number. Let's use 4. So we are saying that 4 is this. When you get 1 divided by 1 out of 4, you know 4 is a quarter. These are like 4 pieces from 1 piece. So when you get 1 piece and divide it in 4 times, you get 4 pieces. You get it? So that is how reciprocals work. So why am I going into again mathematics here? Is I want to bring up a concept called contribution per sales ratio. Contributions per sales ratio. And this is how it will work. Now, this formula of break-even sales revenue is equal to fixed cost divided by contribution per unit times selling price, can be modified in terms of reciprocal, and we can get another formula. So I'll just do the same thing. My break-even revenue is equal to, now I'll try to remove this. Is equal to, so I'm now going to modify this formula. Now, I don't want to have a sales price here. I don't want to have sales price here. So what I'm going to do, I'm going to divide. So since I don't want sales price here, I'm going to divide here. I'm going to divide here by sales price, selling price, and also divide here by selling price. Like I'm going to basically okay. So I'm going to turn this into a reciprocal, just like the way we have here. So if I turn this into a reciprocal, this is how it will be. It will actually be 1. It will be 1. I'll move the 1 here. Divided by 1. Divided by 1. Just try to align this. Divided by 1. Divided by the sales price. So this is what I have. And we are saying that this is the same thing as this. We've already demonstrated here that if it is 2, 2 is the same thing as 1 divided by a half. You get it. And we also went ahead to also agree that 4 is 1 divided by a quarter. You get it. So if this is valid, it means that this is also valid. You get it. So here I'm just trying to remove the sales price from being a numerator for it being a denominator. So this is what we have. So what I'll do, I'm going to still turn this formula. So I'm going to have this. My break-even revenue, let me just put it here. I also do it with this, and I'll say no fill. Also say no fill here. So this will equal to. So now what I'm going to do basically, this will be the same thing. I'm not going to make an adjustment here. This is an equal. Okay, when you multiply fixed cost times 1, you get the same fixed cost. Anything multiplied by 1 gets that. But when you multiply contribution per unit times 1 over sales price, it is the same thing as contribution divided by sales price. It is the same thing as contribution divided by sales price. So here we have fixed cost divided by contribution per unit divided by sales price. You get it. Now, this contribution per unit, or what we are regarding contribution per unit divided by sales price, is also called, we call it contribution per sales ratio. We call it contribution per sales ratio. You get it? Yeah. Or contribution per unit per sales ratio, like that. So if that is what we have, then it would mean that this break-even sales revenue is also the same thing as fixed costs. The same thing as fixed cost. I could just copy this. Divided by contribution per sales ratio. Should be like fixed cost divided by contribution per sales ratio, like that. So that is what would be. So break-even revenue, sales revenue can be expressed either as this, or it can either be expressed as this. You get it? So it's important for you to appreciate how the two formulas might work. You get it, huh? Forgive me for going into first principles here, but this is the formula of how I want to just basically show you how we actually come up with that. You get it. Now, off there, I wish to go back to our notes for us to appreciate what we are studying today and why these things are important. So we are looking at CVP, and they are saying that CVP analysis makes use of the contribution concept, which contribution we've already said that contribution is basically your selling price less your variable cost per unit. That's your contribution per unit. You get it. Contribution is like profit, but as profit looks at beyond looking at the fixed costs, contribution only ends at the variable costs. You get it. So it's very important for us to have that in mind. So, okay. So we have the following measures. We have contribution to sales ratio. We have which I've said that contribution to sales ratio is the contribution divided by the selling price. And then we have the break-even point. You get it. And then we have the margin of safety. And then we have the target profit. Now, the break-even point, we've already tried to go through it, where we are trying to say that at break-even, total cost is equal to total revenue. You get it, huh? And as you can see, at the end of the day, break-even in terms of units, which is our break-even quantity, it can also be total fixed cost divided by contribution per unit. We've already found that when we were doing the tryout. You get it. They're also giving us the contribution formula, which is the selling price per unit, less what? Less our variable cost per unit. You should be able to understand that now. So they are telling you that these fixed costs you can see here. When you move this contribution, when you multiply, it's called cross multiplication. When you cross multiply this goes this side, and it will now be total fixed cost is the same thing as contribution per unit times the number of units. That is what they are trying to, basically trying to make this vertical rather than having one divided by the other, cross multiplying. So it's very important for us to appreciate these formulas and also not just cram them, but know where they actually come from. Know where they come from. So break even in terms of sales value. So break even sales revenue. So break even will equal to the total fixed cost divided by the contribution per unit times the selling price per unit. We've already done this and we've gone ahead to come to this formula. This was our final formula. You get it, where we did a reciprocal of selling price and we were able to get how the CS ratio comes up. You get it. Now, someone might ask themselves, what is this so-called contribution to sales ratio and why do we need it anyway? You get it. Now, you know, when we are speaking about contribution, we say that contribution is the difference between price and costs. Now, why it is important for us to look at the ratio between the contribution to that of sales is basically we want to understand, before we even take into consideration our fixed costs, how much, what is the contribution of each product, you get it, to the sales? What is, it could be that, but what portion of the sales in terms of percentage is the contribution? Is basically what is like our net before we can even remove the fixed costs. You get it. So we're just trying to look at how much contribution is earned. You get it? Now, the reason why we are bringing the aspect on each 1 shilling of sales is because we are dividing. We are saying that it's contribution divided by sales. So at the end of the day, we are trying to look at per each single unit of shilling, what are we making in terms of contribution? You get it? Huh? So it's very important for us to understand this. And then sometimes you may find this being multiplied by 100 because they want it in terms of percentage. Now, you know, if it's a ratio and it's multiplied by 100, then you have a percentage. So if it's multiplied by 100, contribution is basically trying to represent the percentage at which contribution changes with a change in price. I understand by now you must be appreciating what the word contribution basically means. You get it? Huh? Yeah. So contribution per unit per sales ratio, I've already given you this formula ahead. If we are looking at contribution in terms of total contribution, like I said, the contribution per unit becomes total contribution, and the sales price now becomes total sales revenue. You get it? So contribution per sales ratio can be looked at as total in terms of total, but it can also be looked at in terms of the selling price as well. Okay. So it's important for us to appreciate those different formulas. You get it? Huh? Okay. Now, it's good for us to appreciate what CVP does, because all that we are trying to learn is the cost to volume profit analysis, and how we are trying to say how does cost relate with the volume as well as the profit. You get it? Now, the whole factor here, basically what I should say, if we are trying to look at independent and dependent, we know very well that cost depends on quantity. Profits are also depending on quantity. You get it? So cost and profit are dependent factors. And now quantity is independent. Quantity here is being referred as volume, but it's basically meaning the same thing. So why is CVP used? Why are we bothering ourselves to actually use the CVP, the cost volume profit analysis model? And is it really used in the real world? So the CVP, like we've seen, we've brought in the aspect of break even. So the CVP helps us understand definitely our break even point, but also helping us to understand what is our break even revenue. You get it? I think you saw how we went ahead to get down onto determining what our break even revenue is, sales revenue, by multiplying the break even quantity times the selling price. You get it? So it's important for us to have that in mind. And then we are also going to understand something to do with budgeted profit, what some other person can also call targeted profit. Now, why this is very important is because you see, at the start of the year, a company usually has a projected profit, because companies do budgeting. They forecast to see how they will perform in a given period. Now, as the company has a targeted profit, it has to work now backwards to determine what will be the revenue that I need to actually attain a given profit, as well as also looking at the costs. Because one of the things that we know that very well is that the company has control over the costs. Of course, this is a short-term run, but the company doesn't have control over how the market will demand. You get it? The reason why I'm saying costs, because we do production internally. So the hands that we have on are hands on the costs. We can either reduce them or they remain the same, or these costs can actually increase. But for revenue, we have less control over demand because demand is outside determined. You get it? So if as an organization, we want to determine how much we shall basically make in terms of profits, then we work backwards to determine how much we shall make in terms of revenue. Then the CVP comes in handy. You get it? So it's very important for us to understand that. Then we shall also appreciate that the CVP helps us to know what level of price affects the achievement of the budgeted profit. You get it? Like you've seen, if, for example, we have said that we have control over, let's say, the costs because it's us producing, then we have certain sales revenue that we want to achieve. If we realize, according to how our demand has been in the past, that we cannot increase the demand, then the next thing that we shall have is the price, to see what do we need to change in terms of price. And that is why you see companies increasing prices in certain circumstances or going ahead to reduce their prices. You get it? Somebody will say now MTN mobile money we used to send at 1,000, but now it is sending at 1,500 and so on. You get it? Now, all those decisions can be supported by the CVP model, because the CVP model will look into the future and give you an idea of what will really happen when you change your price. You get it? And then, of course, the cost changes, like I said, what happens when the costs change? Since it is the cost that we have a grip on, ours is to understand once we change our costs, once we minimize the costs, maybe we are using a given supplier who charges us a given value. Once we change that given supplier, how much shall we save in terms of costs, and how does that affect our product profitability? You get it, huh? So it's very important for us to understand that. So the relationships are not so much different from what we've just looked at. You can try to read those. I think I want to get down onto the target profit. I want to get down onto the target profit. And I'll just come back to my Excel here. Now, we've already appreciated that profit is the same thing as total revenue less total costs. You get it, huh? So all along the journey of producing, the company can go ahead to have what we call targeted profits. Targeted profits for the year. You get it? And this is feeding into our total revenue, or you can call it total projected revenue, and then the total projected costs as well. You get it? So that is what we basically do have. Now, it's important for us to also understand that this total revenue, that your targeted profits can also be total revenue minus. Now, this total cost is variable cost times quantity, plus the V is variable cost per unit. That is why we multiply it by 2 to get the total variable cost, plus our fixed costs, You get it? So that is what we have if you try to adjust this. You get it, huh? Now, it's good for us to also understand that if we try to expand this, we open this bracket. I could still use maybe the names still. This is, okay, this is V2 minus FC. I hope we are good at that level. Maybe this I could even call it TR. So it is TR minus V2 minus FC. Total revenue minus variable cost. Total variable cost minus FC. Now, if you realize, we say that contribution is the same thing as total revenue minus variable costs. So this formula can also be like this. Is equal to, this is contribution. This is contribution. Total revenue minus variable costs. So this can be total profits is equal to, can call it total contribution, minus fixed cost, minus fixed costs. Total profits is equal to total contribution minus the fixed costs. So if you want to now go ahead to, let's say, you can go ahead to make total contribution the subject in that formula. You can try to make total contribution the subject here, where you have your total contribution. Total contribution is the same thing as that targeted profits. Now what I'm trying to do, I'm trying to take these fixed costs to the other side. So I'll pick this and take it this side. So that's why I'm trying it to now be total contribution will equal to targeted profits plus fixed costs. Like that. So that can be that can also be how this can be. You get it, huh? Now, I hope you remember. I don't know if you remember when we are trying to calculate the total contribution. Total contribution. Now, total contribution itself, from what we have seen, is basically contribution per unit times quantity. So this total contribution is also the same thing as contribution per unit times quantity. And we are saying that that will equal to targeted profits plus our fixed costs. You get it, huh? So we can go ahead to make quantity the subject here and say quantity is equal to, quantity is equal to, I'll try to make it here, is equal to the targeted profits plus fixed costs divided by contribution per unit. You get it, huh? That is what we shall basically have. So this quantity that you've gotten here is your target quantity. Now, since we are looking at targeted profits, it means that This target quantity is the quantity you need to produce to earn your targeted profits. This target quantity is the quantity you need to produce to earn your targeted profits. I might have gone, since I've been using words here, I might have confused you basically. But if you're using just the way we do it, where we say that our profits are equal to T2. Okay, this is P2. P2 is price times quantity, which is your revenue, minus V2 plus FC. You get it, huh? Now, you can actually go ahead to make the subject here. You get it, huh? By, of course, just opening. What will happen here? This will be minus VC minus FC. These profits are equal to, now I can put to the subject here and say this will be P minus V, like that, minus FC, like that. So what will happen later on is I'll now call this P minus V. This is selling price minus variable cost per unit. Since I've removed Q, I can name this and say, okay, this is profits. And remember, these profits I'm speaking about are targeted profits, would equal to my quantity times the contribution per unit minus my fixed costs. You get it? So I can just take fixed cost this side and just call this targeted profit, since just to make sure that not confusing. So these are target profits plus my fixed cost from this side is now equal to Q in bracket contribution per unit, like that. So that is what I'll really have in there. So in case I just want to make sure the subject, I'll just divide contribution per unit this side, then contribution per unit this side. And I'll definitely be able to come to this same thing. So in case the other confuses you, you can just do this very quick one here to be able to get that. You get it, huh? So it's important that you understand how to generate some of these formulas. I hope you have at least a pen and paper and you're noting some of these things. So that is how this formula might come up. Fixed cost plus target net profit divided by the contribution per unit. You get it, huh? Now we have something called margin of safety. Before we look at the calculation, I would want to show you how the chart looks like. Maybe you can understand this margin of safety much more here. Sorry. Okay, so this is how a CVP curve or graph looks like. This is how a CVP graph looks like. Now, I beg you for your attention here. The line that moves from this point, sorry, the line that is moving from here, that is going here, is total cost. Now, total cost will always start from somewhere, not zero. I already explained that because you have some, you could have maybe research and development costs. Startup costs basically are common to every company. And that is why your costs will remain, will start from somewhere. For example, this total costs are beginning from the 10,000 point. Now, revenue will always begin from 0 because you always start from 0 and then start selling. You don't start from somewhere immediately. You start from 0. When you're just setting up, already you have costs going high, but you don't selling to anyone. And that's why we are saying that your revenue will be at 0. So that is why the cost curve will run from wherever it is up to there. And then revenue curve runs from the 0 here. If this is the y-axis and this is an x-axis, these are units. It will start from 0 here, run and also go there. You get it? Now, this point is what we are calling our break-even point, where our sales are meeting our costs. And as you can see, before we get to our break-even, our total costs curve is higher than our revenue curve. So here the company is making a loss, and that is why it is called a loss area. At this point in time, your total costs are higher than your total revenue. But as you get to this point in time, which is our break-even point, the line of total sales and total cost is just at the same point. So your profit here is 0. So going forward from your break-even point, as you proceed, the company starts making a profit. And that's why this is called a profit area. Now, what is called margin of safety is that when a company goes beyond the break-even point, for example, the break-even point of this company, let's say, was at 50,000 units. Remember, this is revenue and costs. This axis has revenue and costs, and this revenue has units. Now, if this company, its break-even point is at 50,000, as you can see, this line cascades down. When you cascade it here, you actually get your break-even quantity. You get it, huh? Now, and of course, when you cascade it here, you're able to get your total revenue and total costs, which stands at around, I think, 22,500. Now, at this point in time, when we have the break-even, that's 50,000. Now, this company may be producing at 60,000. This company may be producing at 60,000 because no company would really want to produce at break-even. Every company would want to leave the break-even point and go at a point in time. Now, if the company is producing at this level, it means that this is its maybe current or current production. Now, the difference between its current production, the difference between the point where it is and the break-even point is like, it's called a margin of safety. Reason why we are calling it a margin of safety is that if it goes and falls beyond the break-even, it will go into a mess. It will start making losses. So I think you've, those that are working or maybe you've studied, you know what safety means. Basically, we are saying that the company is safe. So how safe is the company? How safe is the company is the distance between the unsafe place, which is the break-even, and where it is. You get it. So that's why it's called a margin of safety. You get it, huh? So I just wanted to try to explain that for you before we can try to dig down into margin of safety. You get it, huh? So our definition here is saying margin of safety is the amount by which anticipated or budgeted sales can fall before the company or business starts making a loss. So you know that when a company goes beyond the break-even point, it's a loss area. It starts making losses. You understand? So it's very important for us to understand that. Now, how this is, of course, how it is calculated, we get expected sales, like the 60,000 I showed you, minus the break-even sales. So the difference between your current sales ratio, or your expected sales, maybe this is for planning purposes, when you are looking at expected sales or target sales. When you get your expected sales and reduce with your break-even sales, the difference you have is your margin of safety, because it's by that amount that if you fall by that amount, for example, if our break-even is at 50,000, like we've seen, and then our current production or expected sales, let's say, is at 60,000, the 10,000 difference is the margin of safety. Because if this company falls by the 10,000 units, it gets to starting to make losses. You get it, huh? So that is how margin of safety works. So it's important for us to have that in mind. So margin of safety can also be expressed as a percentage. And of course, it's expressed as a percentage of the expected sales. It is expressed as a percentage of the expected sales. All right, we proceed. Of course, every organization will always strive to have a higher margin of safety, because that would help the company to be a bit much safe. And that's why they are saying that if your margin of safety is unsatisfactory, maybe your margin, your break-even point is, let's say, at 50,000 units, and you're only producing at 5,500. So it means that if you fall by 500 units, you will definitely fall into a dish and start making losses. So we are saying that if such situations occur, the company can do what? Can increase the selling price. Because when you increase your selling price, your total revenue will go high. You understand? And here we're trying to make assumption, of course, if your costs are remaining low. The same thing with reducing costs. When you reduce your costs, all these things, by the way, these are things that increase your profits. If your profit is high, it means that you're far away from the break-even point, which is profit zero. You get it? So anything that increases profit, reducing our fixed costs, reducing our variable costs, substituting existing product with more profitable ones, increasing volume of output, you get it? Modernization of facility and so on. Of course, when you increase volume of output, this is in terms of production, you know that you're enjoying economies of scale. But then at the end of the day, if this volume also matches with the demand, then you're able to serve more customers that will bring in more revenue. You get it, huh? So it's important for us to have that in mind. So we are trying to look at the break-even chart, the graphical representation, which we've just looked at here when we are trying to demonstrate. So this is our break-even chart for you to basically understand. So if you're watching this, you can just look at your notes, then we can try to explain a few things on this break-even chart. Now, for you to also understand, since I've tried to go through this, we also have, now this is called the accountant's model. This is called the accountant's model. But we also have what we call the economic approach, or the economist's model. You get it, huh? Now, the accountant's model, like you've seen, it has, it is straight line, of course, where we are assuming that, we have different assumptions that we are going to look at here. But then also, this model is also has a single break-even point. You're going to see what happens with the accountant's model just shortly. I'm going to show you. You get it? Huh? So this is how the graph is looking like. I've just tried to explain this. I could just give you a glimpse of how the model of the economics would look like for you to appreciate. Now, this is how the economics model looks like. Maybe I would use, yes, I would use this one down. Now, I hope you can be able to see this very well. Okay, so with the economics model, of course, understanding that what this curve that is starting from 0 is your total revenue curve, because revenue starts from 0, and also understanding that this is your total cost curve. Now, with the economics model, we are seeing that these two curves are curvish in nature. They are not like straight line like we've seen with the accountant's model. So that is one, which is the difference. Now, the economists are also saying that with their model, you have 2 break-even points. And our first break-even point is this one. It's the first time when our total revenue curve is meeting our total sales curve, total costs curve, sorry. So this is the first, that is the first point. Now, after that, we also have another break-even point. So the economists are trying to be realistic. You get it? And they are saying that you can never have a company that once they go break even, that they will not come back to make losses. And of course, this is also dependent on two, when it comes to economics, we are trying to also look at what kind of market are you in? Because markets where there are new entrants that are coming in, if a product is attractive, then you will definitely get more other players that are coming in that will, of course, foster competition, and that will affect how much you're taking in as a business. So, and then of course, also by the nature of products, we know the product life cycle. It's one of the things that we shall be looking at even as we proceed. The product life cycle, us understanding that throughout the product life cycle, there's a point in time which we call the decline stage. A product starts from introduction, then growth, then maturity, then at one point in time it goes into decline. So we want to think that also the decline part of the life cycle is responsible for this point in time when the company actually goes back to a break-even point, a point in time where the profits are equal to the total costs. You get it? So it's important for us to appreciate this. So the only point in time where profit is maximized is at this level. Because remember, this is our total sales curve. It goes, you can see it, the one that was rising is going on to reduce. As it is reducing, your total costs keep on going high, like that. The total costs for them, they'll keep on going high. So it's important for you to appreciate how the two are playing. So somebody can ask you the difference between the accountant's model and the model for the economists. So you need to be able to articulate some of these things. I think I didn't, I may not have given you this in the notes, but I'll be able to share with you on the WhatsApp group. So it's good for us to appreciate that. So we go back to our accountant's model, which is looking like this. Like you've seen, this one only has one break-even point. Now, as we proceed up, since you've already seen now how the curve looks like, it's good for us to appreciate some key things. Now, when you're drawing up a CVP, we say that CVP is trying to look at how cost, volume, profit are dependent. Our cost profit is dependent on volume, and where volume is also including things to do with revenue. No, profit is revenue minus costs. So the CVP also looks at revenue indirectly. So this axis is looking at your total revenue and total costs. This axis, the lower axis, is looking at quantity or volume. And why that is so, I think I talked about the aspect of dependent and independent. The revenue and costs depend on your units, which is your quantity. And that is why it is like that. So I think you can see they are calling this area variable cost. Now, the reason why they are calling it variable cost, you remember what we said about fixed costs? These are costs that the company incurs, and they are not dependent on the level of output. You get it? And for them, they'll remain constant even when the output increases. You get it? Now, what we are saying that at the start, when the company has not done any production, the company first incurs what we call the fixed costs, because it has not started production. As it starts production, now the variable costs come in. And that is why you see they have given this shared variable costs, because it is that after this level, when we start now, when we start production, when we start moving away from 0 to increase the number of units. As the number of units increase, even our total costs are increasing. You get it? So this point in time on this axis is your fixed cost when quantity is at 0. When quantity it's at 0, your fixed costs will be at that level because you're not producing anything, so that is your value. You get it? Huh? So it's important for you to have that in mind. If you want to demonstrate that from just the formula here, I'll show you maybe something here. We are saying that our total costs are equal to variable cost V2 minus FC. You get it? Huh? So what we are saying that at quantity 0, when you're not producing, this will definitely be it will okay, this is plus, sorry. This is plus. This will definitely be 0. So your total costs will equal to your fixed costs. You get it? So that is why even when they are labeling the graph, that is what they are trying to mean. So your total cost curve will be at this point, which is the fixed cost. So good for us to appreciate that point. So that is what you need to know, especially when it comes to your graphical representation. Now, we have what we call the uses of the break-even chart. Now, just like the way we've seen about why companies use the CVP model, same ideas, because it's the same thing. So what do we use the break-even? Definitely one of the things that we use the break-even to is to determine the break-even point. At which point will the organization be making profits, or at what point will the organization be making losses? And what is that point in time where the profit will be 0, i.e. the total costs are equal to the total revenue. You get it? So it's pretty important for us to know that. The other is it can also help us to understand any changes in maybe different factors that affect our profits, like volume. You see, for example, if, for example, you're on the graph, you're on this graph, yours can be, for example, if you're producing at, let's say, 20,000, yours should be, what if we increase it to 30,000? What will happen? So what you do, you now cascade, you go to your, plot to your total cost. So your total cost will be those ones. Then we go to your, sorry, this is total revenue. Then total cost, that will be the value. You get it? So you can easily plot different values of total cost and total revenue for given level of units. So it's important for us to have that in mind. You get it? So there are several of those here which you can really read, and when you understand what a break-even chart is, then this you can even be able to think them out of the box. I already spoke about margin of safety. You get it? I already spoke about margin of safety, said the difference between where the company is at. For example, I gave you an example. If we were at this level at 60,000, now it will mean that this area between 60,000 and 50,000 will be our margin of safety. You get it? So it's very important for us to have that in mind. So it can also help us to determine our margin of safety. And cases where we want to adjust our margin of safety, then we can also be able to determine as well. You understand? Yeah, of course, the break-even chart also has its different limitations, as we shall try to see here. You get it? And we are trying to say that a company that sells different products having different turnover. Of course, the break-even chart fails to give a picture when the sales mix changes. One of the assumptions that is for CVP, especially for multi-products, is that the sales mix has to be constant. By sales mix, what we mean is that if you're selling, if you're dealing, let's say, for example, in beverages, you got Coca-Cola, and you have soda, water, and juice. Now, by sales mix, we look at what quantity of soda are you selling? What quantity of juice are you selling? What quantity of water are you selling? You get it? So the combination of those will help us give us a picture of how much, how much each of those would be sold. So we are saying that the break-even chart cannot work when the sales mix changes. You get it? Huh? Yeah. And then one of the other things that the break-even chart does not take into consideration the capital employed, of course, which is an important factor. By capital employed, here we're trying to look at, takes you back to our accounting. You get it? Where we're trying to look at, of course, the capital employed, trying to look at what is your assets and what are your liabilities, what's the difference. So it doesn't really go into the capital employed, because for it is considering fixed costs, which of course, like continuous costs. It's not looking at how much money has been invested into the business. You get it? Huh? And then also one of the things is fixed costs may increase at some level, definitely. Like I indicated, the CVP model only applies in the short run. Why fixed costs may increase? Of course, the dynamics. Rent can be your fixed cost, and the landlord can wake up one day and say, I've increased rent. The warehouse, yes, can also be your fixed cost, similar to the rent. The salary of the CEO could be a fixed cost at some point in time until when the CEO demands for a higher pay. You get it? So the limitations would also be formulated in terms of assumptions. You get it? If somebody says, what are the sum of the assumptions of the break-even chart? Similar kind of principles for you to understand. So we've seen how the break-even chart looks like. Now, we can also have interest into how a break-even chart of a multi-product would look like. Like I said, of course, in this L&H, it's good for us to know that many companies are having different kind of products. Company does not only have, if it's, for example, Movit will have the hair relaxers, the radiance, and so on. You get it? So what happens with the CVP when we have malt products? You get it? So we have two assumptions. And the first assumption they are saying is that the product with the highest CS ratio will be sold first. If you remember, we said CS ratio is the contribution per sales ratio. So the company that has a higher CS ratio will be sold first. You get it? Because the company is trying to look at maximizing contribution. And then they said the order will be followed. And then also it also assumed that the constant sales mix is assumed. Like we've seen up in the limitations, we have seen that the break-even chart only applies where we have a constant sales mix. You get it? So it's important for us to have that in mind. So these are just kind of details of what we just have here, where we're saying that all other variables remain constant. And by that, we mean that it is only volume that is changing. Price is constant. The sales mix is constant. The to do with production efficiency, we are assuming that the company is as efficient as it is across the different levels of output. You get it? Huh? Yeah. Now, when somebody asks you about CVP assumptions, it's good for you to also know that they can also ask you for the limitations. You get it? Huh? They can ask you for the limitations. Now, if it's an assumption, you say it assumes so. You get it? If it's a limitation, you now bring in the aspect that maybe, for example, there it is this, we can say that CVP assumes a constant price, but in actual sense, prices keep on changing due maybe to the forces of market demand and supply. You get it? So you give a limitation in a kind of a negative way of what exactly happens. Why are you refuting the assumption? Like, this is its assumption, but in reality, this is what exactly happens. You get it? Huh? So it's important for us to understand that. Of course, efficiency changes, the sales mix can also change. For example, right now, who is buying soda? If it's, for example, it's Coca-Cola, you find that maybe it is getting more revenue from juice, maybe because people are thinking about their immunity, maybe more revenue from water, maybe you never know what is really happening because there are no parties. So the sales mix has totally changed. You get it? Huh? So you can be able to draft some of your limitations from there. You understand? Huh? Yes. So of course, the CVP model, if it's looking at the single product, of course, it assumes a single product. But then also, if it's several kind of products, it assumes a constant sales mix, which we've already highlighted here. Now, it also assumes that the total cost and total revenue are linear functions of output. That is why you see when you look at the accountant's model, here we're trying to look at the accountant's model, the lines are straight up. I think we just looked at up. The lines are straight from just the start. You get it? Huh? So it's important for us to have that in mind. And then the other profits are calculated on a variable costing basis. I think this is where we are saying that the fixed, of course, the fixed costs that are incurred during the period, for them, they are considered as sort of expense for the period, just like the way you calculate cost of sales and then go to expenses. So with CVP, we assume that fixed costs are like charged as expenses, and that's why we have the aspect of contribution here. You get it? Huh? Then costs can be actually divided between fixed and variable elements. Like you've already seen, say total cost is fixed cost plus variable cost. So it assumes that you can actually divide Definitely, as you proceed with this paper, you'll get to realize that some costs are semi-variable, and means they are both fixed as well as variable. You get it? So it's important for us to appreciate that. So these are all assumptions. You can be able to go through them. Now, the ones that are up are for the multi products. You get it? This is also just a summary that is just trying to break down what we have. Now, these are assumptions, like you've seen, these are assumptions and these are limitations. These limitations are definitely drawn from the assumptions. You get, like, for example, I gave the example of the selling price, yet prices can vary depending on different factors. Of course, we are saying it assumes also variable cost per unit, which can also change. You get it? So it's good for you to know how to present the assumptions and limitations at the end of the day. You get it? Yeah, so it's important for us to appreciate that. Now, I have some questions that I want to give you. So you try out. Because of time, I cannot try out here. But I want us to try out these questions well on WhatsApp. And I want to at least have you active. So what you're going to basically do is do a question and then share your solution by taking a picture of where you've done that solution from. You get it? Yeah. So we are going to calculate break-even point. I'll also be sharing with you my solutions as well. After later on, when everyone has shared, I will share with you my solution just to guide those other people that might have challenges. You get it? So we are going to calculate, we shall try to calculate break-even point. We shall also try to calculate margin of safety. We shall try to calculate target profits and so on. You get it? Yeah, so I hope that we'll be able to run very well. Please make sure that you're active and make sure that you share your solution within a specific time. You get it? You know, we have limited time. You may, this is July, you may think we have a lot of time from now to August, but the time is to September, sorry. The time is very limited. So I need really active participation even as we continue to study. Let's study with this small time, but then also utilize the time we have on ourselves to go in depth of what we've studied and try out questions. CVP has several questions that I'm going to share that you practice. Then I'll also be able to share with you my approach to some of the questions. You get it? Yeah, so any question? Any question in the comment section, which I can maybe be able to answer before we can end this? Is everything clear? Can I know that there are some people that are following? Okay, Michael, Barbara, Danson, what are your comments on this topic? Oh, we're out of class. Now, I have challenges with recordings. I was late, but catching up. Yes, Michael. Let's try people to get a little early here, clear. It's because we have our system, because it has several recordings, it's getting filled up. So we are getting challenges with recording new things. So try to come for the class as it comes. You get it? Yeah, Danson, thank you for joining in for the first time. Yeah, it's clear right now. So I know Lucky came in a little late, but I hope you can be able to catch up as well from the notes. Yeah. I'll see if I can share the recording that can come through, then that will be well for you as well. So it's just a few minutes to 9, and I would love to let you go. Let's continue the conversation on the WhatsApp group. I'll share some questions immediately so that you can try out some of these. Okay, we'll try to catch up. All right, thank you so much for being part of this. In case you're watching a replay of this or you're watching this from another platform, it's been a pleasure to be part of this. Then, in case you want to continue being part of this as we proceed, make sure that you subscribe to the paid class. Then we can see how to help you. So this has been proudly brought to you by Achievers Professional Trainers, and we're here to support you attain that dream of becoming professional accountant. So see you then. Bye-bye.
Samuel. Hello? Hello?
Yes, hello.
This is Lucky.